Hey, Trader Stephen Kowitzel here with thetradersplan.com. It's Thursday afternoon, July the 12th. I hope all is well and that everyone has had a wonderful, wonderful week. Coming off a holiday weekend last week. I don't believe I put out too much last week, but we're really back on this week. A couple quick announcements. If you want to get full resolution of this video, please watch it in full screen because that's how I shoot it. And sometimes when I put it on the website, it gets shrunk. So check that out. Real quick, before we get into the good stuff, I want to put up a disclosure. Excellent. Okay, so we have a lot to cover today, as usual. We're going to go over the market. Commodities really got hit hard, and we're going to look at that and look at some of the relationships and the correlations and how they can affect one another today. We're going to look at some individual stocks, some industries, so just a lot to cover today. I really want to start with the Nasdaq because this is really interesting to me. Let's start over here, right? And everybody remembers this sell-off where you had this, I call it just a waterfall, right? Just everything sells off, hits the 20-day moving average twice on the way down, and tries to reverse one day, didn't work, tries to reverse the second day, that was the winner. Okay. So you have this gap right here, and then you had another gap right here. I'd argue that this got filled, but I would say it really didn't. Maybe it did, but anyways, it never really closed back above that gap. And then you had more downside, and then you had a gap right here and never closed, and then you had more downside. So now we're in a rally mode, and you have a gap, and I'm thinking something similar to what happens over here, and that didn't happen. So it completely filled the gap and then some, and now we're within a stone's throw. We did touch a all-time high today, so it's incredibly hard to get bearish. You can't get bearish when the market's at an all-time high because price trumps everything. So, and I'm going to look at this on the S&P 500 chart, which shows a little bit better, but the rallies are easy, right? They're a little easier because you can just kind of follow that 45-degree angle up. Sometimes what happens is you have these rallies, which are the best, and then sometimes you just get this grind, this chop higher. And those can be really difficult, and sometimes they can be difficult for me because I don't typically you have to be willing to change your thinking and adapt to the kind of market you're in, and I'm kind of mentally preparing myself for that. Instead of really just trading the rallies, buying the pullbacks, buying the oversolds, even if they break the 20-day moving average, because you're in a bull market and a lot of times it will come down, and it clearly found support at the 50-day moving average, filled the gap, and then some, and now we're right here. Now, we're at this all-time high, and I'd like to make note that we got to an all-time high here a couple days into it, and then it rolled over. If we look at that pivot, we got a couple weeks in, and then it pulled back. So a lot of times you don't want to buy the all-time high, you want to buy the retracement. So to me, I don't think this is going to be a rally where it just rides the 20-day moving average here, but you want to buy the retracement, so you kind of got to change things up a little bit. So I was adding some here. Bought a little bit over the last couple days, so kind of sucking me back in, and that's what happens. Now, I'll be honest with you, I thought this was going to be a bigger crack than what it was, but you have to be willing to just follow the market, whatever it does. Here's one thing that bothers me, and I believe I said this in a video to my paying members earlier this week. You have all this distribution right here, all this selling pressure, okay? Lots of utilities surging when the market's selling off. Not really a whole lot of accumulation on the way up. As a matter of fact, just the volume has really dried up. Now we're at 1.2 billion so far. I don't even think we're going to hit an average of 2 billion shares traded on the Nasdaq today. So what I'm saying is we're getting into this point. You got to be bullish until proven otherwise, but we're getting into this point. If this were an individual stock, I would not buy this because when I look at consolidations, right, when you look at cups, maybe it creates a handle, whatever. but there's distribution, and then you can add that as a +1. In a mentor of mine, we used to count the distribution weeks, and we used to count the accumulation weeks. There is more negatives than positives, at least from a volume standpoint. Now, price beats volume, and I've noticed that on rallies, you can see this was a pretty good rally right here. Just a couple accumulation days, but just it wasn't glittered with distribution day or accumulation days, excuse me. Whereas on the downside, it's glittered with distribution days, but so it can move higher, but this is just really, really light volume. So it's something that I'm being just a little cautious on. I probably should own more stock right now than I should, or I probably should own more than I do. So I'm probably about half invested right now. I probably should own a little bit more, but you know, this is kind of bothering me a little bit. But the tech stocks are leading, so you definitely have to play that. You have to play that and assume that that is showing strength, which it is, and we're going to look at that here in a little bit. Now, when I was talking about be willing to adapt to different market environments, this is really what I'm talking about. So this is a better, obviously this would be great, but that's incredibly rare move. So obviously the market is still in one big ugly trading range, and the S&P 500 is really only up about 1 to 2% for the year. So that's not, it's definitely lagging the Nasdaq and probably the Russell 2000. But now it's in this channel, right, where it just kind of, and it's not an exact channel, but it's just kind of going up to the trend line, pulling back, going up to the trend line. These are a little bit harder. Once you identify it, you know, then you can be like, okay, so once it pulls back and kind of touches this trend line, you have to take a stab, okay? You have to assume that it's going to hold until it doesn't. And I always say you have to take a stab. You have to be bullish as much as you can, because you know, there's even Peter Lynch said, the great money manager of the Fidelity Fund, that there's more money lost anticipating a bear market than the actual bear market itself. So I try to keep that in mind and just stay bullish. Now, whipsaws happen. So it's kind of an ugly support. This right down here, it didn't even find support at the 50-day moving average, is not like this clear as day, one big reversal candle, and then it takes off. Nothing like that. Kind of chopped around, but it came back. So the market isn't always neat and clean. It's really, really sloppy sometimes. But if we look at from a horizontal standpoint, you know, the S&P 500 is right at this 2,800 level, where the last 3 times it failed. So it failed right here, it failed right here, and it failed right here, and here we are again. Is this, so I could just draw, let me draw this auto resistance right here, okay? So that's clear as day, at least to me. So is this going to break through? I don't know, or is it going to just kind of pull back and set up? I do know if it pulls back and set up, I'm going to probably add some more stock, unless it, and then if it breaks, I'll just get out, you know, take your loss, whatever, that's just part of it. But this 2,800 level seems to be of importance. And what happens on Friday? Fridays are typically pretty good days in the market. It's just everyone's feeling good about the weekends, and then Monday comes in, bam, sells off. So Monday and Tuesdays are typically the best days to buy stock, just because, you know, people, the theory is people talk about, you know, the sky is falling over the weekend and come in Monday morning and sell their stocks. But the 2,800 level is important. The fact that we are in this rising channel right here, I think is very important to know, that we're not in some major rally like this. We're more in this just rising channel. So I remember in 2015 where the market just, every time it broke out, it was just whipsaw city until it absolutely rolled over. So I'm not saying that this is the end of 2015, because that was bad. But what I am saying is just, I remember every time it broke out, instead of buying, I started shorting and I was making money, because that was just, you notice that after it happened twice, it just continued to follow that pattern. So right now I'm looking at this to see if this can continue or not. But again, not a lot of volume on this bounce. It's just kind of a head scratcher to me. but tech stocks are roaring. So don't stay bullish. I always say stay bullish until the trend lines start to break. Now, I wanted to show the Russell 2000 for a couple reasons. I'm seeing a lot of evidence. Now, commodities got whacked yesterday, and it could have been the $200 billion in tariffs that Trump is going on China. But it's funny because the market can't be too mad about the tariffs because the Nasdaq's at an all-time high. So it doesn't seem to be too worried. But if the dollar, and then the dollar perked up, and now the dollar is really at an inflection point and has been, and we're going to continue to look at that. But emerging markets are looking like they're trying to bounce. We're going to look at that. Commodities could perk up. If the dollar does crack a little bit, the Russell 2000, and you can see right here, the Russell 2000 is, that's a weekly chart, so we'll have to look at a daily chart, but is underperforming the last few days. And I'm just wondering if that is an early sign that the dollar could crack. We're just going to have to wait and see. I think that this score will be settled within the next week if the dollar is going to just continue to roar higher and commodities are going to break down, or vice versa. Because right now, sometimes most of the times they'll go in opposite, sometimes they'll go in tandem. It really looks like they're now kind of starting to move in opposite, which, so I'm looking at some evidence, and now the relative chart of the Russell 2000, at least in the last couple of weeks, is underperforming the S&P 500 as the dollar has been going sideways. So just something to keep in mind if you're in some leveraged ETFs, that the Russell 2000, if the dollar rolls over, it could, get a deeper pullback than the large caps. So just something to keep in mind. Now, I want to go back to the S&P 500 chart real quick, just to show you. So as we're getting out of this ugliness, and this is ugly, don't get me wrong, but you kind of had a shakeout right here. You have another shakeout right here. We could just take off from here. I don't know, but I keep coming back to the shakeouts that happened in the previous corrections. You had the 2011 correction where it was clearing all these pivots. It was looking good. One more shakeout. Oh, you thought you were good. Then you just go on this massive, massive run. And these runs can last a long time. So I try to keep in the camp of, if it pulls back and then just reverses real quick, the market wants to head higher. And I'm not going to say it's going to be an easy time ahead, but all I'm saying is these could just be shakeouts and just could be exchanging, strong hands for weak hands. So just kind of keep that in mind. Rallies can be incredibly good coming out of corrections, but you can have a couple shakeouts along the way all day long. And if we go back to the 2010 correction, this is pretty good. It rallied for a couple months. Look at this. And this is interesting. It rallied so good for a couple months, and then everyone thought it was going to crack wide open. It broke the 20-day moving average and then just went on a major tear again for like 3 months. So all I'm saying is just keep in mind that these shakeouts happen, and try not to get too bearish at all. Except for I'm a little bearish on some international stocks right now. Okay, so it was really interesting. So this is the CRB down here. It came down. Actually, I kind of want to shrink in this chart. Let's just see if kind of blow it up a little bit. Whoa, that was ugly. Let me undo that. Okay, so you have the CRB right here. It came down, broke out of this inverse head and shoulders. Came down. It was at a trend line, put a nice reversal in, and then just shake out, roll over. Right as the dollar is getting into this zone, potential resistance zone, and then the dollar perked up and commodities got slammed. So as of right now, you can see on this line and on this line, now it looks like they're definitely in tandem, in the opposite direction. So if the dollar perks up, commodities, industrial, copper, they're already looking ugly. Gold is looking interesting, but it's weakening, so we'll just kind of keep our eye on that. But if the dollar perks up, that's going to continue to put downward pressure on commodities. I think the trend line will finally break. And if you had asked me 2 weeks ago, I was going to say the dollar was going to break. So it just goes to show you how much kind of whipsaw it can really happen. But you know, this is a trend line that goes all the way back. It's a 12-month trend line from the middle of June of 2017, and it's not drawn on there, but you could probably see it clear as day. And if that's a 1-year trend line, if that cracks, I would take it incredibly seriously. And this breakout right here would fail. And it's really interesting given where we are in the business cycle with inflation. But I've just seen commodities. Gold was looking good last week, and now it's looking a little suspect. So it's just, I'm going to continue to watch the dollar. It's down a little bit today, but continue to kind of keep my eye on everything. It was really interesting. So this is the this is the relative ratio of the S&P 500 versus commodities. And you can see you definitely want to be in the stronger of the two, and one can be stronger than the other for a decade at a time. You had the 90s to 99, the S&P returned 266%, the CRB negative 19. I bet you'd want to be in the S&P 500. This is why I don't really like buy and hold commodities, just because they can just be out of favor for so long. And then you had the relative ratio going down. CRB returned 69%, while the S&P negative 8. And then from November 2011 to present, this is probably not quite as updated, probably a few points off. I think it's been about a month since I've updated it or two. But the S&P 500 is just smoking the CRB. And right here, it looked like the CRB was going to take off when it was going down, which means the CRB starts to outperform. And I thought this was going to crack wide open, and it just reversed higher. So again, stocks are outperforming commodities, and it doesn't really look like it's even close. So just when you think that commodities are going to take the leadership, things can change incredibly quickly. So you have to be willing to, no matter what opinion you have, change it quickly. So this is the S&P 500 versus emerging markets, and you can see you wanted to be in emerging markets from 99 to 2011. Same time as you wanted to be in commodities. See how they all kind of go together. And then the lines going up, meaning you really wanted to be in the S&P 500 over emerging markets. So the dollar, is the dollar, and that's right now what we're really looking at. So this is a smaller chart, so we're not going to look at this. But gold is just, it seems to be struggling, the price of gold. And miners were outperforming, and now they're, could just enter the trading range again. So if we look at USO, let's just look at one of these commodities right here, and it's reversing today. So you have the USO, United States Oil Fund, right here, broke out. Again, you don't typically, buying the all-time high breakouts is just, buy the retracement. But anyways, it got slammed yesterday. Like, it was down 5% yesterday along with everything. Oil, gold, copper, just all the commodities got slammed as the dollar was perking up. So today it's reversing a little bit. What does that mean? I don't know, but it has a long way to go to negate this 5% slam. What does the dollar look like today? Dollar's up a little bit today, and you can see right here the dollar really, actually I want to go to the USD. Okay. This updates at the end of the day, but you can see right here, so the USD was in this 95 zone, started to get pulled back, and then just reverse at that 50-day moving average, looking like it was going to break. Momentum was definitely slowing. It was entering this level of resistance. At this time, it was pulling back. Gold was going up, and then it just found support, reverse. And at the same time, gold reversed to the negative side, and then just went inverse to the dollar. But gold is up today, and we can look at that here in a second. But, maybe this is just a basing pattern, and we'll just really have to wait and see what happens. But the 93.50 area, this zone all of a sudden seems to be pretty important, or at least the 50-day moving average. Obviously, if this 93.44 breaks on the dollar, I would say, you know, gold can take off from there. But we really just have to wait and see and keep our eye on it. But things change very, very quickly in a matter of days. Okay, so this is the VEU All World US ex-US ETF international stocks. The red and green line, it broke a 2-year trend line, and it looks pretty ugly, and it broke this horizontal support right here. And you can see how interesting when this gets weak, the dollar gets strong, and vice versa. There's an inverse relationship here, and it's looking pretty weak. It's been looking really weak since the dollar has gotten strong. Now they're both at an inflection point where they could cross, okay, where the dollar could get stronger and our VEU could get stronger and the dollar could get weaker, or the other way around. The dollar could get weaker and this could go back up. So they're at one of these crossing points where they could either cross right here or go the other way. And these ships, it doesn't happen in a day or even a week. Sometimes they can take months for these to play out, but just right now, the important thing is that international stocks are weak, and that U.S. stocks are outperforming international stocks, emerging markets, and commodities right now. So you definitely want to be overweight U.S. stocks. TLT. Let me get a sip of my Spark. Okay. Well, that's good. Got a little powder there. Okay, so TLT. Got the bonds right here. Got the 20-year Treasury bond ETF. This is really, really interesting because it's in a bear market. I think that's easy to say. Bear market rally, but put in this double bottom right here, okay? And bonds broke out of this little downtrend. You have a higher high right here out of this 121.06. You have a higher high, you have a double bottom, higher high, a breakout. Now it is at a 2-year downtrend line. So with this happening, bonds could be breaking out of a 2-year downtrend. Now I want to show you that. That doesn't mean the stocks are going to roll over, because we're going to look at some correlations here in a second. But it's just pretty interesting how much bonds have moved up and moved up recently. And looking at the chart before it made this higher high, man, it just looked like it was going to roll back over. This was just, you know, a rising wedge, bear market rally. It was going to roll back over, and then all of a sudden it creates a higher high. Breaks out of this downtrend, breaks out of this downtrend. So, but obviously that's very interesting being in the rising interest rate environment, because, you know, the Fed is raising interest rates. But if bond prices are going up, that obviously means that interest rates are going down, and we'll look at that here in a second. So let's look at the TLT correlation relative to the XEF. For the most part, you can see it is in this negative correlation pane right here. So if bonds are going up over time, it means that typically financials are going down. It just means that negative correlation right there. So I really, and it's just, there's so much going on right now. I really think the market really could use some financials, and I think we're going to get some earnings. You know, we're entering earnings season. So keep in mind, by the way, always know when your stock's going to report, especially if it's a growth stock. We're entering earnings season, so earnings banks could just completely throw this up, where you have a positive correlation, but kind of looks like this is going to break out right here. And so far, as of lately, for the most part, there's a negative correlation with XLF, which is the financial ETF. So, interest rates and bonds have an inverse relationship. Look, it is almost at a complete negative one. So there is never positive, really correlation with yields going up and bond prices going up, because when bond prices go up, yields have to go down to make up the difference in the yield price. So complete negative correlation, that's no surprise. The correlation of the TLT to the S&P 500. And I just showed this just to go to show you, just because bonds are going up, it's not a doom and gloom. And you can see the correlation is all over, kind of whenever it wants to be. So right now it's close to zero. It went from negative to positive, or to zero means there is no correlation. But you can see for the most part that there's not a lot of correlation with as of lately in the last 2 years. Correlation of TLT to gold. Most of the time, as of in the last 2 years, you can see there is a positive correlation right here of TLT to gold. All of a sudden, it's been negative. And there can be other factors at play here. But if we're kind of keeping our eye on this long-term relationship here, if TLT could go up historically, or at least in the last 2 years, that means that gold should go up with it. So we'll keep our eye on that. So just kind of recap this. Typically, financials are negative when bonds go up. S&P 500, to me, I just wanted to show this to you, that the sky isn't falling if bond prices rise. And gold, over time, or over the last couple of years, typically has had that positive correlation with TLT. So if we go to the 30-year, where is that? Okay, the 10-year, excuse me. And this goes all the way back to 1974. You can see that the 10-year, it got above 3%, right? And it poked its head above this big inverse head and shoulder, bull flag breakout, all that good stuff, and is pulling back. And this is a 40-year chart, so 43-year chart, 44. So this is a very, very long-term chart. But I always show this just to show how interesting it is. When you go from a rising interest rate environment, or from a lowering interest rate environment to a rising interest rate environment, it takes time to just completely turn the ship. This base has been going since the middle of 2011. That's 7 years. This top over here went from 1980 to 85, 86. So about 5-6 years. So when it took this to turn, it took 5-6 years. We're about 7 years into this, approximately. So it doesn't, it's not an exact science. As far as they're not V-shaped. It's not going to go straight from rising interest rates then straight off from there. But we're so close to breaking out, and you could argue that maybe it's already broke out and just easing a little bit. But interest rates are pulling back a little bit, which is, maybe the reason bonds are rising or vice versa. So everything is just, it always interests me how everything is just kind of brought together. So let's just look at the breadth real quick. And I was actually impressed with the market breadth on the S&P 500 surge, because I didn't look at it a couple of days and all of a sudden breadth was just up there. So the percentage of stocks above the S&P 500 above the 200-day moving average are still at 67%. Yes, they're curling down a little bit. We'll see where they finish the week, but that's still bullish. We're in a bull market. Expect bullish outcomes, right? When this 50-day moving average crosses, when the S&P 500 either starts breaking these lines or the 50-day crosses under the 200-day moving average, then you can expect bearish outcomes. But until then, I'm going to try to be a bull just because that's what makes money. So you have the market breadth, in my opinion, is still bullish. Let's go to the sector summary, and let's just kind of see. Let's just kind of go fishing a little bit. Technology is up today. That's incredibly strong. Like it blows my mind, the QQQs and everything, like how just reluctant they are to go down or make any serious down move. They are just leading the way, and there is nothing wrong with that. You're in a bull market and technology stocks continue to lead. You gotta roll with the punches. Today, utilities are going down. Staples are going down. That's a positive sign. That's because they are defensive plays. Now, yesterday, utilities and staples were up. So it's just But I like to, I kind of like to just look back on the 1 week. We've had a good week in the market. The market's bounced. Utilities are at the bottom. Technology is at the top. Positive. However, let's go back just a little bit further. Utilities have smoked everything. Not even close. They're up 7.5% relative to healthcare, consumer staples. So really you have 2 out of 3 defensive sectors in the last 20 days, in the last 1 month, that has been the strongest, when you have industrials, materials, financials that have been the weakest. So I always like to look at the 1 week and the 1 month, just kind of get perspective, and it's really just interesting how utilities are the weakest this week, but on the 1 month they are still strong. There is clearly, to me, money flowing into utilities. Actually want to go look at the XLU for a second. Okay, so the XLU, it's been weak. It literally rolled over way before January did, when everything else rolled. It rolled over 3 months before. The 50-day is back above the 200-day. It has cleared these pivots. I would say utilities are in an uptrend. You had this box, right? This basing pattern right here that it's cleared. It's cleared all these pivots, the 50-day above the 200-day. Now it's back in a bull market. And boy, this thing has really surged. I mean, just really surged. So utilities, maybe sometimes I'd rather be in cash than own utilities, because that's kind of telling me about something in the market. But I can't remember exactly what year it was when I was a financial advisor. It might have been 2011 or 2012. Nothing was doing well, and just utilities were up 20% for the year out of nowhere. And I'm not saying that's going to happen this year, but market breadth in utilities went from incredibly weak to incredibly strong. I might be go fishing for some utilities this weekend to see what I can find, see if there are any utilities with, that look like they could continue to make an advance. But breadth, utilities, everything is looking right. I don't know if that's a good thing or not. Typically, that's a defensive sector. So that's telling me that I kind of want to stay away from it, or just be cautious. The XLF, man, this thing's weak. It is at a downtrend line. It cannot break out. It just can't. It is up 0.11% when the tech stocks are up over 1%. Okay? And probably has to do with the rising TLT, right? Remember that negative correlation? So it's at this downtrend right here. It's at a descending triangle. If I could draw it, there's a downtrend, there's a horizontal. That's typically a bearish pattern. But if it breaks out, I'm all in. But man, I'd really like to see some financials going higher. Maybe we get some of that in earnings season. But breadth is really starting to weaken in the XLF. I do want to look at a bright spot. I don't know why that. No. Come on. XLK, technology. Look, what do you want to be in? Do you want to be in the leader or the laggard? Technology. This is at a 52, an all-time high, probably. I mean, it's just strong. Like, it is, and this is not really an easy thing to play, but look, remember what we just looked at, the S&P 500. If I could draw, kind of draw those channels on there, you could play those. It's probably not the best. Actually, what I want to do, I wonder if, no, that's not going to work out. I was going to draw a raw progression channel on it. But anyways, here, let me draw the downtrend. So if it does pull back, as it probably will. It's breaking out to an all-time high. If it does pull back, I see that as an opportunity. Look at all these oversolds on the RSI 5. They would have been mostly opportunities in the strongest sector. So if we just go vertical on this, look right here. It wasn't the exact bottom, but you had a double bottom. Boy, that was perfect. As it's coming out, pretty close, and you can see as it's coming out, there's pretty good entries. So when you have an incredibly strong ETF, if it's coming out of an oversold RSI 5, I mean, it's not a bad setup. Now, when you're in a correction, sometimes you might want to consider RSI 10, but it's just, they're not bad setups to play. But I would only do that with the strongest ones. I wouldn't play that with the weakest ones. If we just go back and look at China for a second again, boy, that looks weak. This is a Shanghai exchange. I mean, this is a bad deal for China right now. It does not look good. It is very close to this horizontal support right here, but I mean, it looks bearish. I'm assuming bearish outcomes with this one. All trend lines are broken. It's at horizontal support. Maybe it gets saved, maybe it doesn't. I think the dollar would help, but I think the tariffs are hurting them. I do. So I want to go in and look at, let me go back here. Actually, oh yeah, let's look at some industry. Let's look at the industry summary. Okay. So while the market's strong, let's just look at what is strong in the market. So you have the sectors. You always want to buy the strongest stocks and the strongest industries and the strongest sectors. Say that 3 times. So you have the sector, cyclicals, technology, energy, and then you have the industries, okay? And I always try to focus on the strongest industries and the strongest stocks and the strongest sectors. Yep. So toys and retailers this week are strong. So what I typically do once a week is I'll just scroll through here just to see what's standing out, like what is really up a lot. Software, internet, there's a lot of broad participation in technology. That is not a surprise. Industrial suppliers are bouncing back. So far, that's the biggest gainer out of all of these. Materials, kind of weak. Energy, not as strong. Staples, not as strong. Healthcare, biotechs. Biotechs and industrial suppliers are the strongest industries. And then you have utilities, which are down, but we can look at the 1 month and be up, and then finance. So this week, I don't know much about industrial supplier. Here, let me duplicate this real quick. Let's say 1 week. Okay, so let's look at each one and industrial suppliers, and let's just see what is popping. So typically what I'll go in here is I'll say, okay, is it one stock moving it or is it broad participation? I would say one stock that's up 147%. It's probably not great. That's probably moving a lot of it, but Fastenal, that's a pretty, let's rank it by scooter. Let's see which ones are just moving. I don't know why it's doing that. Come on. That doesn't really look interesting to me. I want to kind of go back here and look at biotechs. And I know there are a lot of biotechs. Look at that. Look at that broad participation in biotechs. You ever heard the term honey hole? To me, that's your honey hole right now. And if, let's see what they've done in the last month. Yeah, man. I think biotechs are making a comeback, and I continue to kind of comb through the list. We own one right now that so far is working. Probably should be owning more, but there is such broad participation in biotechs, which is interesting. It's always interesting to me because I saw biotechs pop after Trump said they were going to take them on, so go figure why they popped. That's broad participation right there. So I mean, you do not have to have a stock charts subscription to go in here and play with this and just say, okay, I'm going to look at these. Then I'm going to rank it by Scooter, which is a stock charts proprietary technical ranking. It gives, it's a 12-month ranking, gives more weight towards the most recent price action. It's like a relative strength rating. But you can kind of go through here and just, look at, I bet this one's already gone to the moon. Yep. So some of the ones that are way, way up there already have, maybe they've already made their move, but maybe you can find some stocks that are really, really early in the move. But it's just crystal clear to me. Yep, there are some biotechs not doing good, but in the last week, there's money piling into these things, and it's not all. Let me look at this one. What happened there? MNTA just took off. That's some pretty good buying. I'm not going to buy here. I'll buy the retracement, but you know, maybe you see this, maybe you read about it, and then find a retracement. You're like, okay, this is showing strength. This is one of the strongest stocks and one of the strongest industries and one of the strongest sectors. Maybe I put an alert if it hits a 50% retracement, and then I consider it for a potential purchase, right? So you take these and you find ones and you say, okay, and this is what I do every weekend. I put them on my watch list, and then I'll put an alert on a price that a potential entry where I think is a safe entry. And then once it hits that, I'll get an email, and then I'll look at it, and I'll either decide to purchase or make a pass at that time based on what it's doing, what the market's doing. So I hope this was helpful. Let me know if you have any questions.